We should be alarmed, but it's localized. My expectation on Friday was this could be a financial crisis. Global bond price action is concerning, particularly Japan.
For the JGB, this is the highest it's been since 1996. That's crazy. The bond market is flashing a fire alarm. It's saying we should be on red alert.
Repo markets are showing the opposite of crisis right now. It really is an attack on the Eurodollar system in many ways. Scott Bessent said gold and Bitcoin fit this role last year.
Iran, obviously, late last month or early last month, they said, we're going to be accepting a toll in Bitcoin. And 5 days ago, they announced that they launched a Bitcoin-backed insurance policy. This is perhaps the most important geopolitical Bitcoin development in history.
If you're missing that angle, you're going to miss out on the next 10 years of Bitcoin.
Quickly, guys, I'm not going to ask you to like or subscribe, but if you do want to support the podcast, share it with one person you think might gain some value from it. Okay, so for today, we have fixed income market legend Nik Bhatia and macro expert Joe Consorti. They have an amazing back and forth on whether or not Trump keeps chickening out as yields rise or if there's something else at play. They do a deep dive into how this might be an attack on the Eurodollar system and why Bitcoin is then perfectly positioned to win. And we start the conversation by analyzing the current global bond market chaos and whether this could spiral into an all-out financial crisis and where. Awesome, Joe, Nik, thank you so much for jumping on with me last minute. I had to get you guys on here because, Joe, you and I were talking a little bit in the back channels there, but it looks like there is a ton of chaos. The global yields are continuing to rise, and this is not my area of expertise. So I need to bring the experts on to see what's happening right here. So we got the Japanese 40 years hitting all-time highs. I think I saw the Japanese bid went bidless at one point in time. G7 countries are the highest yield since 2004. I saw Scott Bessent is also issuing 30-day licenses for Russian oil. I thought that was pretty interesting. Basically, long duration is blowing out. So Nik, you spent a lot of time before Bitcoin in the fixed income world. What are you seeing here? Is it anything reminiscent of stuff that you've seen in the past? Should we be alarmed, or am I maybe blowing things out of proportion?
We should be alarmed, but it's localized. And that's really the analysis that I'm trying to bring this week to the table. US Treasuries are the largest single asset class in the world in terms of, being one issuer. Obviously, the stock market is multiple times the US Treasury market, but by itself, the US Treasury market is so enormous. So any movement in the Treasury market has ripple effects throughout the entire system. That is without a doubt. However, the price action in Treasuries is much less concerning to me versus the price action in the rest of global markets, particularly Japanese bonds, as you mentioned, and UK bonds to a lesser extent, and German bonds also to a lesser extent. The dollar is worrying me in terms of going after some of the emerging market currencies. So what happens there is essentially a flight to safety, where you get people selling their emerging market assets and then going and selling the currency that they get when they sell those assets and buying dollars to escape their current risk exposure. So the dollar rallying is concerning. Global bond price action is concerning, particularly Japan. It's not that Japan itself, the economy is collapsing or that the fiscal house is collapsing. It's that guarantee of more money creation from policymakers, whether it's the government doing it or the central bank doing it or a combination, which we really see that combination consistent for the last 20 years. Sometimes it's hard to pinpoint what the inspiration for the save is and even where it's coming from, but it's coming from that combination. It's government, it's policy, it's the big save. So long story short, I'm concerned globally. I'm less concerned on the US front. I think the US has proven that it can sustain 4.5% treasury yields. I think it has proven that and I should say, when I say it, I mean the stock market and the economy. Labor market in the United States is relatively strong. The stock market is essentially at all-time highs. This is all with treasury yields at 4.5% to 5% in the long end. So inflation is a concern globally. It is really damaging global bonds because interest rates are a function of inflation and inflation expectations. You want a yield to compensate you for that growth in prices. So in the United States, though, the ability for the economy and the stock market to tolerate these rising yields and the government's ability or inability to provide that policy response here in the US, I think is pronounced. You're not going to see Bessent and Powell slash Warsh run to do any big QE program, fiscal stimulus. You're not going to see it here in the US, I believe, in the short run. There's nothing that warrants it. And that nothing is it can be summarized by, hey, treasury yields in 10-year popped above 4.5 and above 5% in 30-year. That should be a big deal. But guess what? Stocks not really knocked. And policy definitely not paying attention. I mean, even the populace in general worried about 4.5 to 5% yields. They're just not. It's not in the mainstream. It's not in the forefront. So and I'll pass it to you guys, and Joe here, but I really think that splitting it and not sounding the alarm in the US or in any US fiscal way today is important. And then on the global side, I'm very concerned about a few pockets here.
Quickly before I pass it to Joe, I just want to unpack one thing quick, or two things. In terms of the inflation expectations, if I understand correctly, that's what we're seeing in the bond yields being priced in. Where is the inflation going to originate from? Is it purely just because of supply constraint with the ongoing crisis in Iran? And secondly, you mentioned the dollar rising as a concern. Why is the dollar rising as a concern?
Yes. So where is the inflation coming from? The trigger, of course, is the Strait of Hormuz closure and the oil price shock. So that is absolutely the trigger here. But one of the things that I just noted is that housing price inflation as a component of CPI has started to creep up trailing 3 months here, meaning that there is a demand component to the inflation wave. And what is that demand component? It is a blisteringly strong US economy on aggregate. And that US economy that right now Atlanta GDP has at about 4%, that that's a real GDP number. The nominal, if you add another 4, because CPI looks like it's, going back to 4, you're at 8% nominal GDP growth in the United States. There is a capex boom unlike we've ever seen. It's the largest capital cycle we've ever witnessed. And that capital cycle, it guarantees GDP growth because that spending is all lined up. And those construction workers are all bid forward. The commodities, the inputs are all bid forward. And there are shortages on energy and compute several years looking forward. So my view on the US economy is extremely bullish over that, let's call it 2 to 4 year time horizon off of the back of this global capital cycle. So inflation is coming from demand as well as this oil shock, which is a trigger. And being able to tell what is the main contributor here or there, it's difficult when you get down the line. At the beginning, the price at the pump, it's obvious that that's the oil shock, but it's also obvious to me that underlying inflation and let's say, prices paid in ISM surveys going back several months, it's been pretty strong. It's enough to show me that there's a strong economy which is leading to inflation. Because what is inflation other than more money chasing the things that are available? And so that more money comes from where? Well, it can come from policy, money printing. We haven't had any of that. So it's coming from economic growth. So it's two places. And the dollar question, why is dollar concerning? Because based on our liquidity approach, we have our proprietary index TBL liquidity at the Bitcoin layer. it gives us a sense of what's moving markets. The dollar is a negative contributor in that empirically we've studied it. When the dollar goes strong, it damages risk assets, including stocks and Bitcoin. And that's also a broadly uh, discussed financial condition, is that the dollar itself is a financial condition on the world. When it gets strong, it tightens financial conditions abroad, because foreign borrowers have a less easy time to pay back their existing debt, and it's more difficult to borrow going forward, also because your forward revenues are unable to pay that interest that you are mapping out. So that's the answer to the dollar question.
Beautiful. Joe, there is a lot to unpack there. Where do you agree? Where do you disagree? What are you seeing right now in the credit markets, and then everything that Nik just laid out for us?
Yeah, so me commenting on Treasury markets after Nik does is like me shooting right after Tiger Woods, right? That said, I could do my best here. Look, one of the things that Nik brought up, which I think is very disconcerting, two things. Number one being what's happening with JGB yields. So obviously, the Japanese yen is one of the most popular currencies for the carry trade, being able to borrow at a low interest rate to invest at a high interest rate, namely in US financial assets and US markets. The higher that yields creep up on JGBs, the more difficult it is to execute that trade. And ultimately, positions have to be unwound at some point. So the stronger you see yields rise on JGBs and the stronger that the Japanese yen gets relative to the US dollar, it puts those who have a carry trade on in a bit of a hairy situation. So that's one thing to watch. And I can actually go ahead and share my screen here. If you take a look at the magnitude of this move, it's kind of insane. You can see here, this is the entire price history. If you were to go over the last, 1 month, doesn't look super disconcerting, right? A move up 38 basis points, not the end of the world. This looks a little bit worse, considering we were basically at zero, right? We like to think that we had near zero interest rates here in the United States. Looking at Japan, they've trounced us for decades. Right now, on the 10-year yield for the JGB, this is the highest it's been since 1996. That's crazy, right? So you have arguably 30 years worth of equity trades that have been underpinned, increasingly so, by cheaply financing in the yen. You could see it mostly dropping following the 2008 financial crisis, and obviously since 2023. And it just has been creeping up relentlessly. So that's something I'm going to continue keeping my eye on here, particularly looking at potential failed auctions and things like that over the summer as it unfolds. That said, the current route in the bond market right now, not terribly acutely felt in the equity market. Obviously, we felt it last week, massive sell-off in equities. And by massive, I mean like a 2 or 3% correction, which of course can happen, and so we need to pump those numbers up. And so now we're only down 0.3% over the last 5 days. And so ultimately, what this is signaling to me is that, number one, what Nik said, the bond market crisis that we're experiencing right now isn't at an acute enough level for equities to massively sell off. They're not at a high enough level for everything downstream to reprice, for mortgage rates to hit 7%, for the S&P 500 to take a 10% haircut. We're not there quite yet. And the second thing that the S&P 500 is telling me right now, and that the NASDAQ is telling me too, is that there's optimism around the war in Iran ending. And Nathan, I don't know if I was on the show a couple of weeks ago, but I think we were discussing every single time that yields creep up, that the 10-year creeps up to 4.5%, that the 30-year creeps up to 5%, but mostly the 10-year, Trump tacos. So Trump tends to cave and say that we're talking with Iran. And lo and behold, late yesterday and early today, we have new news about a peace deal. Who knows whether or not that will materialize, but ultimately the market does love job owning. And so we are sort of in this, we are at a critical inflection point in the sense that we're at a level where it's uncomfortable if the 10-year were to stay here for months or the 30-year were to stay here for months. But the way things are trending now, ideally, it seems like the war is ending sooner than later. So this won't have as acute of a pass-through effect into the real economy. At least that's the ideal, right? I think Nik can agree where this starts to get hairy is if this continues for another 3 months, maybe 6 months, maybe 9 months, because we've gotten so used to cheap money as a country, not just consumers, but the country itself. We've gotten so used to cheap money that the cost of capital being at 4.5% for the government, but also for consumers, is really bad for a sustained period of time, at least right now, right? But that's sort of the way that I'm reading the tape here. It's, the bond market is flashing a fire alarm. It's saying we should be on red alert. But ideally, the balance of risks are tilted in the favor of this resolving sooner than later. Ideally, bond yields creeping back down to earth. Hopefully, JGB yields cooling off sooner than later. So a lot of action in the equity market doesn't get unwound. That's sort of where we are. And, a lot of this does hinge, as I've been saying in my videos for the last 2 months, like a broken record. A lot of it just hinges on whether or not this war can end sooner than later, right? Because the longer this persists, the more inflation you get that the Fed can't fix, right? The Fed can influence rates higher in order to create demand destruction by constraining credit conditions when inflation is caused by too much credit. But they can't do it when inflation is caused by extremely high oil prices, right? Any rate raises that you do, any monetary and fiscal monetary tightening that you do, all that does is create even more demand destruction, right? Rather than destroying inflation. So that's sort of where we are right now.
Very interesting. Nick, I kind of want to unpack that a little bit more. And I'm curious your sense, maybe I'm completely wrong, but it seems weird to me. So you're right. We had Trump come out and say that they're in the final stages of talks and the 10-year dropped 10 bips. We also saw WTI drop down quite sharply as well, too. Not only that, I was watching the Canadian Treasury market because I pay attention to Canada because I'm stuck here.
I didn't know you guys had one.
I know, right? There's 5 buyers probably. It came down 13 bips as well. Now, correct me if I'm wrong, Nick, but 10 to 13 basis point moves intraday feels large to me, but maybe it's not in the grand scheme or the history of fixed income trading. Is that a volatile move? And then additionally, to Joe's point, do you think that even at these current levels, if it's sustained for too long, that will end up becoming a problem for the US economy that's currently not really showing distress?
Okay, I hope you're ready for a long rant here.
Let's do it.
So many things. The first one on the 10 to 13 basis points. So you're right historically that those are large moves, but the way that markets work is we have these things called Bollinger Bands, but that's maybe too technical. The idea here is that we have, let's take a US Treasury. You have 100 years of price history. So you have an average over 100 years, but then you have an average over the last 10, over the last 5, over the last year, over the last 2 weeks, essentially. So the market is not thinking about 100 years or even 10. It's thinking about the last 3 years, 1 year, 6 months, etc., and then zooming in. So then when the bands start to increase, that means that actually the moves are starting to increase. So the expected moves tomorrow are larger than they were a month ago because the moves over the last month have been larger. So that's a long way to say that today's 10 to 13 basis point move is not a surprise at all because of what happened yesterday, the day before, and on Friday. So Friday set up today's move where it can, you moved up so high that the snapback it's in proportion. So today's move, totally in proportion. Now I'll get to the 4.5% thing in a second because it's essential to talk about. But I wanted to talk about Taco first because I want to get Joe's opinion on this. Also, he probably has read me write about this, but Taco is not the right setup for this to understand. It's the better way to understand this is that Bessent is the Secretary of Volatility. That's the correct framework here. Now, what's the difference? Taco means Trump always chickens out. It means that when he sees the stock market get skittish, he changes his opinion and then changes what he says. It's a superficial way to see what's happening, even though it captures the emotion of it. So, but I think it's the wrong way to set it up. The reason is because if it was really Taco, do you think he would have ended the war when we got that first major oil shock, oil up to 120, the world completely freaking out, the strait closing? That is when you chicken out and give up on the war and literally chicken out. But he didn't chicken out. He continued the military excursion, as they're calling it, and achieved objectives that went on for weeks beyond that initial price shock. So I actually think that objectives are more important than what the markets do. With that being said, you have the Secretary of Volatility, Scott Bessent, watching the move index and seeing, hey, at what point are the global markets genuinely concerned about what we're doing? So let's dial it back. So the better way, instead of Trump always chickens out, is this administration has objectives. It will do everything it can to push the limit, and then it's hired a hedge fund veteran to be the Secretary of Volatility and make sure that the market is not exceeding the limit to the point where it collapses everything. So that's really different than Taco, even though Taco's like a new catchy way to describe the fact that when the market tells them that they've hit the limit, they walk it back. So both things are accurate, but it's important to really dive into Taco, pick it apart, and label it as the wrong framing, because if you believe in Taco, then how do you explain the fact that the war continued to go on after the oil shock and that we still haven't had a deal yet, even though oil is still at 100 plus, depending on which day you're looking at it? So maybe Joe wants to go there, or you want me to continue with the 4.5%. I'll let you decide.
Joe, let's get your response.
I like it. Nick, you always have a really good way of breaking things down and dispelling misconceptions. And, ultimately, I think these are all different variations of a very similar thing. And it all really harkens back as well to sort of the original version of this in markets, which is the Fed put, right?
Yes.
When the equity market declines below a certain level, the Fed decides to reverse course, right? They put the floor underneath the market in the same way. Managing Treasury volatility. That's sort of Scott Bessent's MO. And I know I'm not nearly as smart as that guy. He lives in a $4.5 million house. So he must be, he has this 4D chess all mapped out in his head that I don't
It's
quite
pink
have.
too, isn't it?
It is pink. It is
It's
pink. It looks like a
gorgeous.
Barbie dream house, but the guy is brilliant. And apparently he also fights people in the White House, which is pretty baller.
I've heard
so
that too. Yep.
Can't argue with the guy. Yeah.
Beautiful. So then continuing, Nick, the 4.5, and additionally too, is there an upper limit you think in like the 10-year Treasury that like, no, that wouldn't be sustainable? We would break quickly if it continued to rise past.
Absolutely. And it's more mathematical than anything else, because when the yield goes up, this is not a market that is controlled. It's a market. So when the owners start selling, I mean, that's a disaster. So yeah, at a certain technical level, the selling accelerates, the put buying accelerates, volatility goes through the roof. And at that point, the financial system at large starts to seize up because treasury markets are not functioning. Therefore, repo markets can't really fund the right activity. You get dislocations and you get a straight up financial crisis. That's why the MOVE index is the largest weighting in TBL liquidity, our liquidity metric. It absolutely is. So yes, there's a level. And what I'm looking at with the MOVE index where it is, and yields are where they are today versus 2 years, 3 years ago in various parts of the curve, I'm sitting here saying the odds of that type of level being breached and an all-out spiral in volatility is low. Like, it's less than 50% in my opinion, in my probability distribution, and I would say significantly less than 50%. So I always like to play a game as the odds maker. Is I give the odds to myself, and then I say, hey, would I take that bet? And if I would, then the odds aren't right. Like, if I'm quick to make the decision, then it's where I'm indifferent to take the bet. So would I take let's say the odds were 33%. So I'm getting 2-1 on my money. Would I take that? That we're going to get that we'll get a financial crisis, or that let's say yields break a certain level and we get I think 33% is too high, because I wouldn't I just don't think that the risk reward is there for that type of bet. And that's how I come up with these, odds in my mind of what I think the probability of something is happening. So I'd say it's pretty low, the probability of something like that happening. Now, on Friday afternoon, I made a prediction to my TBL pros that I think policy response is coming outside of the country. It could happen at Paris next week with the G7 finance ministers. So I'm watching that. Tuesday and Wednesday went by. What happened on Wednesday? They said, we have no plans to do anything. And so the bond market continued to, sell off. It wasn't until Trump said something about Iran and that hit the oil market and then helped the bond market come back down in yield. So the policymakers, in Europe didn't have anything to do. But what happened this morning? India, Indonesia, and South Africa, central banks, governments are all starting to get involved already. So my expectation on Friday was this could be a financial crisis. It won't be in the United States. It might happen abroad. Whether or not it's a crisis, we got a policy response by Wednesday. So about 5 days, 6 days after I made this prediction. So that's more the way that I like to think about these odds. And so now I actually have to reset because the prediction and the odds that I set for myself and my expectation on Friday, it already resolved to the point where, if you bet on taco, you get to pay yourself out because that's the framework that you had that, oh, at a certain level, Trump would come out and say something in the news to hit the market down. So again, that's why taco has some validity to it, but it's really it's from my perspective, no, it was the rest of the world that had to come and actually do policy response. So I think that the US is in a good position. And to answer your question directly, probability is low for a move event.
When I first got into Bitcoin, I was overwhelmed. The jargon, the security risks, the fear that one mistake could cost everything. I remember staring at my screen and wondering, are my keys safe? Did I do this right? That experience is why I started BTC Sessions. For over a decade, this channel has helped millions of people like you learn how to use and secure Bitcoin. But I realized something. For many people, videos aren't enough. Everyone learns differently. Some need to ask questions in real time as an expert walks through their setup, their goals, and their threat model. And certain things like advanced cold storage, inheritance planning, privacy, and node or mining setups often can't be fully solved by watching another tutorial. So I built BTC Mentor. I recruited the best Bitcoin educators on the planet to work with you one-on-one. Real experts, real answers, personalized hands-on guidance tailored to your exact situation. Whether you're brand new or building a complex setup, we meet you where you're at and walk with you step by step. By the end, you don't just hope your Bitcoin is safe, you know it is. If you're ready for that level of confidence, then head to btcmentor.io and book a call with us today.
Very good. I just want to quickly jump on two things, then I'll come back to you there, Joe. In terms of the repo markets, because it's not something that I watch or I don't think without a terminal, I don't know that I can. Has there been any issues in the repo markets? Has everything looked great there over the last couple months?
Joe, I can hop in with this latest on SOFR because I was just looking at it. Um, Repo markets are showing the opposite of crisis right now. And I think that that's something that you just don't hear with all this dollar doomerism culture that we're in. The repo market is showing that it's flush with cash as people sell foreign assets, come into the dollar, put their money in money market funds, which then have extra money to fund the repo market because it's secured by Treasury collateral, which they still view as very good collateral, pristine collateral. So the SOFR spreads have actually gone down and are approaching the floor of the policy window. So the opposite of tightness, the opposite of a shortage of cash, the opposite of a worry to fund dealers in the US backed by Treasury collateral. So it's a flight to safety bid going on right now. One of the things that I wanted to respond to with Joe's opening rant was the carry trade and the carry trade unwind. It's all about carry. This is like the one of the first things that Joe and I discussed is his understanding of and when I say Joe and I mean 4 years ago in 2022 when I hired him at the Bitcoin layer and fresh out of college, and I'm like, hey, let's talk about markets. And I hired Joe because he was already, an autodidact. So he's learning, these things. He's reading books about carry and asking me what I think about them. So the whole carry trade component of this is essential to understand. And when you see the Treasury repo market onshore flush with cash, it's actually evidence that a lot of the carry trade built up over the last several decades might be unwinding. And actually, I think a lot of it has unwound to a great degree, and that the attack on the Eurodollar system through the LIBOR mechanism and through things like stablecoins, which are forward looking, it's not a current attack on the dollar system, but I think just tightening policy from 0 to 5.5% was an attack on the Eurodollar system. Keeping rates higher for longer was as well. Keeping them here, and this whole Strait of Hormuz crisis, it really is an attack on the Eurodollar system in many ways. And the way to think about that is through the carry trade. So I've just introduced a lot of complexity there. But
I was gonna say,
yeah, I'd love to hear Joe. Joe's the brainiac, so I want to think. I'm curious what he thinks
I'm
about
the
all these things.
brainiac. What are you talking about?
get in there, Joe. What's your thoughts on that?
Yeah, it's interesting, right? I think the stablecoin conversation is a really interesting window. The Strait being closed is an interesting window. I'm not sure if you guys saw the latest news a couple of days ago, but Iran, obviously, late last month or early last month, they said, we're going to be accepting a toll in Bitcoin. And then Trump shot down a bunch of their planes. And then they said, okay, we're not doing that. But then 5 days ago, they announced that they would be accepting, they launched a Bitcoin-backed insurance policy. That came just 3 days after they had about $400 million worth of Tether frozen. And they specified on their website, which talks about this specific insurance policy, that they only accept Bitcoin, which is very interesting because the decision in early April said, Bitcoin and other crypto. They tried doing it, and then the assets got frozen by Tether. And so this is a really interesting moment for Bitcoin, specifically as it pertains to the Strait. Not to change the subject matter, but that's the thing that my ears perked up about. We've seen obviously El Salvador adopt Bitcoin, but in my mind, this is perhaps the most important geopolitical Bitcoin development in history. And I think this is going to be the first of potentially many moves from other nations who are looking to move out of the US dollar system. And I'm not a US dollar doomer. I was trained by Nik on this. The dollar is going to remain the preeminent world reserve currency, the incumbent for decades to come, in my mind. But it's going to get a bit spicy because we've had these BRICS countries who have been purportedly trying to assemble a hard money-backed basket of currencies. It hasn't worked. They've threatened to arrest one another. None of them are friends. And so clearly in a very multipolar, fractured world order, you need a money that doesn't really rely on any counterparty and that cannot be frozen by any other entity. And Bitcoin is perfect for that. It's money for enemies. And so this begs the question, with Iran moving to do this and showcasing that, look, we can do this at scale and our assets won't get seized. What does that do for Russia, who has had its reserves frozen in 2022? What about China, who's trying to move away from the US dollar system? What about India? What about South Africa, right? Smaller countries, but certainly emerging markets, all of which are trying to move to a hard money-backed basket of currencies. And then you have the strategic Bitcoin reserve. Reportedly, there's an announcement coming about that very soon. Don't know how true that is. Either way, it brings up some very interesting questions, right? Is Bitcoin finally breaking into the mold as a reliable alternative to trade over the US dollar in a world that's increasingly fractured? I'm of the belief that this is, of course, a multi-decade process, but I'll be curious to see how the U.S. responds here, and if that response will include buying a crap ton of Bitcoin, which I think it might, because if you want to make the lives of Iran and China and Russia really difficult if they're trying to move away from the U.S. dollar system, is buy a ton of Bitcoin before they can.
I want to see if I can bridge those two ideas together there. And Nick, let me know if I go completely astray here. One, I also want to highlight there was the Indo-Pacific Command is running a node and exploring Bitcoin strategy as well too. So you got that additional US layer to throw on top. So Nick, you're perceiving this potentially as an attack on the Eurodollar system, which, if I understand correctly, with the offshore dollar system, are you saying that it's basically trying to have the price of money be set domestically, or actually have liquidity come back to the U.S. versus outside the U.S. domestic
The
banking
latter,
system?
right? Trying to raise rates so much that you're draining liquidity from emerging markets.
Yeah, so the former, they've already had enormous victories trailing 5 years to reprice money in the onshore dollar market. That's what SOFR is.
Yep.
It's a secured rate by Treasury collateral. The latter is the attack. It's trying to get money back to the United States, but it's more that you're trying to get money issued by the United States. The Eurodollar system is dollars issued outside the country. So where are the dollars issued? So right now, US companies don't lend to a Brazilian trading with a British company. They're not involved in that transaction. Those dollars are created by offshore banks to facilitate that trade. The dollars have claims on onshore assets through banking liability daisy chain, but you're right that you want the dollars to come back to the United States, but it's really that the dollars exist because a bank creates them. So where is the location of the creation? I think that's what the attack on the Eurodollar system is. It's a desire to weaken the ability for offshore entities to create dollars to meet the demand that is there, and reorient a lot of the trade through the United States. Like, the attack isn't okay, what is the attack? It's when the United States says, "Hey, send all your tankers to the West Coast, load them up, and send oil back to Asia." Well, when the oil is here and leaves the country, that becomes an onshore transaction. So that's the attack. That it's trade flows, because the Eurodollar system arose to meet the flow of money outside of the country. So I hope that clarifies it a little bit on the Eurodollar side. And I have an idea on the Bitcoin as strategic reserve as well.
Okay, so I definitely want to double tap on that as well. And yes, the Eurodollar system, I've tried going down that rabbit hole. It's massive and it's a black box and it's quite hard to unravel. But let's go into the strategic Bitcoin reserve, your comments on that. But also, if we're having less dollar creation issuance outside of the US, which would then, I think, lower liquidity, would that further incentivize people to switch to a different reserve asset like Bitcoin beyond even the censorability of it? Does Bitcoin have more of a use case outside of the US if we're trying to remove the dollar creation ability from the offshore market?
So I think that what you're discussing is what the U.S. government is thinking about. It's also what I told them that they should be thinking about.
Okay, perfect.
When I was in Washington. So
very subtle flex. Very subtle.
Bessent said this last year. We need better neutral reserve assets. So what he's saying is, we wish you to hold our treasuries to a lesser degree. I mean, they've communicated this starting at the beginning of Trump too. We want better global reserve assets, and we want you to use them so that you are not using treasuries and increase the imbalances that are in the global economy because the US purchases so much stuff from abroad that everybody just has all this dollar stock and uses it to buy treasuries because that's the global reserve asset. That's part of the big problem. And it's everyone's fault. It's not China's fault. The US can blame China for depreciating its currency, devaluing its currency, and undercutting the world and dumping. This all about dumping, really. When we think about this Trump to their approach, they're like the number one sin is the dumping, right? And that's a currency. That's a currency result. Like it's just cheaper, and it's a an overproduction, mercantilist sort of way as well. But blaming now as the analyst, I can see why the US pins it on China, but as an analyst, it's everyone's fault. It's the US's fault also for buying all of that stuff.
Yeah.
Like we didn't have, we meaning the US didn't have a policy to protect us against their devaluation. They could have, but they didn't, because historically, going back forever, and most of the thing that I do, after hours is read history. It's protection is over your industry, and protection against unfair trade practices is like the number one theme in all of economic history when it comes to policy and governments and kingdoms. So the United States asleep at the wheel, absolutely the US's fault, and bipartisan, by the way, across both sides over multiple decades. You can start blaming them starting in the 60s, 70s, 90s, 2000s, however you want to slice it. It's bipartisan. And because everyone is at fault, the United States has to understand that its policy toward China is not going to fix everything. It has to figure out how it's going to fix this issue. And one of the ways it can fix it is to have less foreign ownership of US treasuries. And that seems like it would be a bad thing because you're removing a buyer, but the long-term benefits are going to be there. So it makes it very difficult. This is not an easy task. And Bitcoin, I'm not saying anything original. Scott Bessent said gold and Bitcoin fit this role last year. It is part of their approach. I don't know how much is part of their active plan. It's not like I have some grand insight into what they're doing, but I do read and watch all the Bessent speeches and public appearances to try to get that sense. So you're circling what they've been talking about. It is Bitcoin and gold. That's all that we have in that realm. And that by itself it's so bullish for Bitcoin that I really, it's a case of, man, if you're missing that angle, you're going to miss out on the next 10 years of Bitcoin. The people that think I missed it on Bitcoin, they're not seeing this angle, because you did miss the first 5 orders of magnitude, going from, or 7 or 8 if you want to start at a cent, going from 1 cent to $100,000. So you missed every single one of those orders of magnitude. But are you going to miss the next order of magnitude from 100,000 to $1 million? You will probably miss it if you don't see the forward demand for a neutral reserve asset.
Beautiful. You did make a comment there briefly about the strategic Bitcoin reserve, so I just wanted to see what you had to say about that. And then, Joe, I got some questions for you.
Yeah, it actually wasn't about the SPR, but what he said reminded me of another story that nobody talked about. And I wanted to tweet it out, but the day is short.
Fair.
This was the headline that it was I'm going to pull it up because I really don't want to botch it, but the SEC essentially allowed crypto stock trading. So this is 2 days ago. The Reuters headline is SEC readies plan for trading crypto versions of stocks Bloomberg News reports. So you can make the shares crypto form and trade them on that platform. What does that do for the layered money thesis and Bitcoin as the reserve asset of that type of asset? And this will be a walled garden where you probably won't be able to take it out of the exchange and like self custody your crypto Nvidia shares, but maybe you will, and maybe there are markets that develop, and the more that cryptography based transactions are the norm globally, the better Bitcoin looks as the reserve currency of all of that activity, and the less that the dollar feels like the reserve asset. It'll just feel like another interim crypto thing, like a, can I curse on this show, Nathan?
Oh yeah, you fucking can.
Like a fucking stable coin, okay? So it really, I mean, this whole stable coin thing is like, it's the gateway drug to Bitcoin. This is not me saying this. I don't think that this is an original take here, but it really is. And this crypto stock trading, not crypto stock trading, the shares themselves are going to become in crypto form, so that in whatever native environment there's crypto share trading going on, Bitcoin becomes this natural digital gold. That's the entire layered money thesis. That's why Bitcoin is best described and understood as digital gold. It's why I wrote Layered Money, to explain to people that Bitcoin and PayPal are not the same thing, and I take accounting-based offense to that statement. It is just not the same thing qualitatively at all. The only thing you can compare Bitcoin to is gold.
CoinKite has been in the game for years, creating hands down the best and most secure hardware when it comes to securing your Bitcoin. The Cold Card Q is an absolute powerhouse and my daily driver, and it's ideal for newcomers and advanced users alike. The Tap Signer gives you a low-cost, user-friendly option for those just getting started or for convenience when traveling. You can head to coinkite.com and use code BTC Sessions for discounts, or simply scan the QR code on the screen to get started right away. One company I like pointing people to when they ask about Bitcoin mining is Abundant Mines. They were founded by Bo and Christine Turner after losing over $500,000 to broken promises in the mining industry. And they built their hosting model to remove the usual headaches. With Abundant Mines, you own your machines and keep 100% of the Bitcoin you mine. There's no revenue share, no hidden skims. Pricing is simple. One flat monthly fee covers power, parts, labor, and repairs. They also guarantee uptime. If a machine goes down, their hash rate redirect system routes hash power from their fleet, so earnings don't just stop. And every machine is insured at full replacement value. Everything is hosted in the US, powered by Hydro, and mining equipment may qualify for 100% year one bonus depreciation. Learn more at abundantmines.com/sessions.
Joe, I'd love to get your response to that. I'll even throw in there, I think I saw the CME was pushing for the Clarity Act, talking very favorable. That I'm not sure if CME trades Bitcoin futures already at this point in time, but it seems like maybe that was their angle. Your thoughts on the what do you say, like the tokenized stocks? It almost to me feels like a push, like stablecoins going for dollar usage abroad under the control of the Treasury. It almost feels like a reach for more capital flowing into U.S. markets if that can freely move around the world.
100%. Right. It's like we are now in this world where it doesn't make sense to restrict access to U.S. capital markets right now. And also, I just saw a stat, and I put out a post about it. It said by 2030, 1 in 5 Americans is going to be over the age of 65. And I quote tweeted it, and I said, wow, if you still think you're getting a dime of your Social Security check and you're, under 40, you won't be, unless they decide to print a ton of money. But the point there being, like, the necessity for asset prices to increase no matter what has never been higher, right? all of these people are now going to be drawing on their 401ks. Right? Massive sell side pressure. What do? You make it so that you have tokenized equities, and then you make it so that perhaps you don't need an American depository receipt in order to, invest in international companies or whatever the foreign equivalent is to invest in American companies. You just buy a tokenized version of the stock. It also allows for 24/7, 365 liquidity. So maybe instead of having the market open and the market close, everything trades like Bitcoin now. So that's sort of the other angle to it. But I think the biggest story, the biggest angle is the demand for this sort of flywheel of, obviously, stablecoins are one of the biggest on-ramps into Bitcoin. Stablecoin legislation, really aggressively trying to pass it. We need a marginal buyer of US Treasuries. It is just so abundantly clear that they are trying to make it so that stablecoin legislation gets passed. It's very favorable. They hold US Treasuries in reserve, more stablecoins get issued, more Bitcoin gets purchased, rinse and repeat. And so now, the very thing that Bitcoin was designed to replace or allow the everyman to hedge against is the thing that the system is depending on to survive. It's very cool and very ironic. And as far as Bitcoin being a better option as a neutral reserve currency than gold, 100%. I mean, this is the reason that BRICS is failing with its current plan of creating this gold-backed currency. Not just the fact that all of these countries' leaders hate each other, but the fact that you can't settle high-frequency, high-volume international trade in something that weighs a ton, like several million tons. You're not going to be able to do that in a physical commodity, but you can do it with a digital commodity. And I think now the lines that were previously blurred between Bitcoin and crypto, they were never blurred at the Bitcoin layer, right? I always threw crypto in quotation marks. We still absolutely despise crypto, but it's like, now at the governmental level, they're beginning to be distinguished. You see the CFTC talking about how they're going to be the ones regulating Bitcoin. It is a digital commodity, right? Whereas the SEC has jurisdiction over basically everything else. And the Clarity Act, one of the big things is that they're trying to make it so there is a true test that needs to be passed in order to determine actual decentralization, what goes under SEC jurisdiction, what goes under CFTC jurisdiction. And so not only do Bitcoin's monetary properties serve countries who want to settle trade in Bitcoin and hold it as a world reserve currency better than gold, but also we're now saying that at the governmental level, right? And that's very important. We're saying that this thing is a commodity. So it's all one big step in the right direction. And in that world where everything is tokenized, equities are traded more via this tokenized form than they are on the New York Stock Exchange, then you're going to need an asset to hold in the meantime when you're not trading those equities. And obviously, you've got stable coins for that, but more importantly, you've got Bitcoin too.
Beautiful. All right, gentlemen, a couple more questions here quick. It's so wonderful to have you both on screen. I'll just put you in a nice precarious situation. Joe, end of year Bitcoin price. What are you thinking? I know there's a good reason though.
Have you ever seen that clip on CNBC where the guy says, "Sorry, I can't hear you. My audio cut out." I was not going to play that trick. My goodness. Well, it all depends on what happens with the war in my mind. That is the key thing. Okay. We know markets have always sold off over the last 6 or 7 new Fed chairs over the 60 days that ensue after it. The S&P 500 has always been down, right? So we know that this summer is going to be choppy. It's also going to be choppy because of the war. And so in my mind, the sooner the war can end, the less of a likelihood of extreme demand destruction, the oil shock getting worse, and inflationary recession. And in that world, right, where the war ends, many experts are saying mid to late June. So I'm saying mid to late June too, because I'm not a geopolitics guy. So if the war can end before mid to late June, I think that the likelihood is very high that Bitcoin ends the year at a brand new all-time high, right? Whether that's marginally above where we were, whether that's at $150,000, I do not know. But I do believe that the balance of risks are tilted in Bitcoin's favor probabilistically if we can end the war before mid to late June. If we can't do that, in my mind, the risks are extremely high that the oil shock continues. At that point, it will have been 4 months since the Strait of Hormuz was closed. Obviously, we import extremely cheap oil, and it's responsible for 20% of the world's supply. We've already begun seeing the effects of that. You pair that with a consumer that's sort of on the brink, despite the fact that right now the U.S. economy is in expansion. I think the longer you allow the war to drag on, the increasingly likely it is that that we start to see, and we see an even bigger asset sell off than what we see now. We see a true inflationary recession occur. So that's sort of how I'm thinking of things. So I'll say that. I'll be probabilistic about it. I think if war can clear up sooner than later, $150,000 Bitcoin, I wouldn't put too, I would assign that a high probability. If not, maybe this price is a good price to end the year at. I don't know. Maximum pain.
Beautiful. And then just for the fun of it, Nick, your old colleague here, let's assume the war ends mid-June, over under on the 150 call.
Under, but I like Joe's probability distribution. That's how I like to think. I think if you have a range and you think, well, if this, and then if that, you're approaching it the right way. So I'm very in line with the way that Joe's thinking about it. I think the distribution somewhere between here and 150 is right. I've also been thinking all-time high by year end. I'm around 50-50 that we can get that. So, I mean, that I think just with what Joe is saying, can I just on the 4.5%, because we didn't get to finish.
Yeah.
And I wrote it down because I'd like to close the loop. The US economy can take 4.5. The US stock market can. Can it take 5 on both fronts? I think potentially yes. But where can't the economy globally take US 5% rates? It's many, many places. And so DXY, the dollar index, is the best place to watch when it comes to what that tolerance level is for the world to stomach that type of inflation-induced higher interest rates, which, that's why a lot of this talk comes down back to the Strait.
I love it. Nick, where can everybody go to check out your work?
TheBitcoinLayer.com is where you can find everything that we're doing. So a couple places that you guys can go from there. You can go to TBL Pulse. This is our new data terminal. It's free to try. You guys can see TBL Liquidity Index for free there. And if you want a more intensive research experience, we do that on Substack, thebitcoinlayer.substack.com.
Absolutely love it. And I just want to reiterate, it is so, at least personally, nice for me to have you guys both on the screen together again as well. Joe, where can everybody go to find you and your work, sir?
It's a true throwback Thursday. This is being uploaded on Thursday. If not, then it's a throwback, whatever day of the week it is. But yeah, if you want to find more of my work, you can, if this is a collab post, you can click right there. And then click Joe Consorti, the one with the glasses. And then if you're watching this on YouTube, you can just search Joe Consorti up there, find my videos.
If you enjoyed this episode with Joe and Nick, check out the previous episode with Doomberg and James Lavish or the recent live stream.